All right, everybody, welcome to the third session of the Underwriting Fundamentals Workshop and final session of the workshop. We're going to have a little bit of fun today. We're actually going to go into a couple of financial models. I've had some folks ask me about the one I use for not doing syndication. You can pretty much fill it out in less than 10 minutes and have a pretty decent result on what you need to offer for the project, and provides a bit of after-tax information, which you don't see anywhere else. And then we'll go into the synthesis analyzer, and we'll look at its back of the napkin worksheet, which is pretty basic. But if you've ever heard me talk about the cost markup spread, which is what started all of the underwriting on pro forma. The institutional investors started that process using cost market spread and actually put data and fundamentals to what they were doing and an understanding, pretty much doing what developers do. And then the students indicators, or I should say the gurus, they decided, hey, these institutions are overpaying for properties. I guess we can do the same thing. And they did not put fundamental principles into it. They just said, go ahead and overpay. The market will come to you. Well, I'm going to show you that on the back of the napkin for the synthesis analyzer, how you can identify that cost markup spread fairly quickly to see if it's worth fully analyzing the deal or not on a pro forma basis, if you can stomach the risk of underwriting on pro forma, which a lot of people do. I don't personally aspire to it. I like to stick to the fundamental principles, but there are people that do, so I will show you how to do that. And then we'll go into synthesis and actually play around with a larger property, which is what we have for the agenda. So I could have thrown the agenda up and said, okay, well, first we're going to talk about back of the napkin for JV. That's my tool. And then back of the napkin for syndication, that's synthesis, and then going in and analyzing a property. So everything I just said is just covered right there. Yeah, that's why we prepare for these things, right? And I've started preparing for today's lesson at 6:30 this morning. It is 10:04 now, but it didn't take very long to prepare. I started doing some other stuff after that. So then we will conclude this whole underwriting workshop and look at some homework for you, and then get into a Q&A session, which will be the final Q&A session before we head into the holidays. Okay. Any questions before we get started? Now, for those of you that are on here, if you guys have a T12 or a P&L or something from a property you've seen recently, if you want, because we're gonna grab a T12. I don't care where we get it from. I have multiple on my computer, and we're going to take the information from that T12 and we're going to put it in the synthesis analyzer so you guys can see how that process works. But if you've got one you want to do, we never did get any kind of financials from the assumptions that we did last week. We understand how to do the assumptions, so we're not going to go over that again, but we will use assumptions. We're just not going to go see what they are. And I'll show you how they fit into the synthesis model when we put that in there. And same with my back of the napkin. Those assumptions work either way. It doesn't matter what tool you're using. Okay. So if there's no questions, I don't see anything in chat. Let's get going. So back of the napkin. This concludes the PowerPoint presentation. Let's go play with some tools. Let's see. Let me find. We're going to do mine first. So can you guys see the multifamily underwriting workbook? This is where you type yes,
Yes.
say yes. Okay,
Yes.
thank you. I can't see you guys. I've got you hidden. I don't have that much computer space. I do have 2 screens. But in order, well, I guess I could, because I'm not doing PowerPoint. I can spread you out and see you visually. There we go. Now I can see you. All right. So this is a tool that I built myself. I built it from a class that I took, CCIM, go figure. One of the smartest people I know for Excel, who happens to be a professor at the University of Denver's, what is the name of their, I could picture it in my head, Daniels School of Real Estate. It's their MBA program for real estate investing and developing. And the CCIM Institute provides the curriculum for their MBA program, by the way. Anyway, Jeff Ingolstad has a class on how to build your own discounted cash flow model. And I built this from that class. Okay. So this is a 29 unit building. This is just something I put up here, and we can change this to be whatever you guys want it to be. And we'll actually change it so you can see some of the numbers. But you can see we have a purchase price of $1,695,000. That was the asking price when this was an actual deal I looked at. I can't remember if it was local or not. Looking at the assessment of land and building, it does look like it was local because we've got really, really, really low land value in Alabama. So it had to have been in Alabama or Mississippi. I just don't remember where. I did this a long time ago. Anyway, purchase price of $1,695,000. I'm assuming I'm going to have about $50,000 of future acquisition costs. My cost of sale at the end of year 5, I'm predicting 6%. And my disposition cap rate, I'm predicting at 8%. So these are input cells that we can input ourselves. Okay. Anything that's gray, we can input. Then building data, 29 units, average. Why isn't it? That cell appears to be protected for some reason. It's not clicking on it. The heck's going on with my tool? There it is. Oh, my cursor is above. That's weird. You guys see that? Watch. I'll click on 29. It highlights 750. I'll click above the 5,800. It highlights the 5,800. What the heck caused that? Anybody know? I've never seen that before. That's weird. So I just got to realize I'm clicking a cell up, apparently. In any case, 29 units, average rent per unit. In this case, I'm going to the pro forma rent, the market rent for potential rental income. And I'm going to adjust by vacancy in year 1 for what the actual rent is. So on this deal, the actual rent was $563 a month, I believe. We'll be able to see that when we go into the back of the napkin. Matter of fact, I'll just verify it real quick. So if I go to the, whoa, that one ended up over there. Hold on a second. I'm going to minimize you. This is supposed to be over here, not over there. Let me increase the size of this. There we go. Yeah, 563. Now this one works right. I wonder why the other one's doing that. So what I did was I'm going to adjust for vacancy in year 1 to account for the loss to lease in this case. Okay. Including any credit loss and actual vacancy. I got other income of $5,800. That's about $200 a unit. And I got an operating expense ratio, again, just year 1 of 60% because the rents are so low on this property. Yes, go ahead.
Where did you get that 25% from?
What I did was I took the market rent, or the what I believe to be the potential rental income for this asset. And because I want to use that, then I need to be able to adjust for it in the discounted cash flow down here. So you can see my potential rental income is 261,000. But in order for me to have my increases correct for annual increases, what I'm using is vacancy to adjust for any variances. Well, now it's working, right? Does that make sense?
So you had a 25% vacancy in the property.
No, there's not. So physical vacancy on this was about 7 or 8%, but I'm adjusting for loss to lease.
Right,
Because
but
I'm saying potential rental income, if all units were 100% rented at market rate, it's $750.
right.
So I'm accounting for year one because year one needs to be actual. So I really need year one to be at 563 average rent, not 750. So I'm accounting for loss to lease, physical vacancy and credit loss all within vacancy year one. Does that make sense? Again, this is just back of the napkin. Richard, you got it?
Yeah, no, I was saying is I was on mute. So you took the difference between the 750 and the actual rent to come up with 25%.
Correct.
Okay.
That's correct. Okay. And then I had to adjust for the operating expense ratio so that my expenses were in line with what it is on the actual financials. All right. And I can adjust that here. Moving forward, it will adjust again by bringing the vacancy down. So you can see here, I'll have all my variables and we'll go over these in a minute. These are the assumptions that we did the market analysis for. And of course, we have our assumption here from the market analysis. Remember, part one was what is your potential rental income or your market rent? So then we got financing data. I want the minimum of loan to value or debt service coverage ratio. In this case, I'm using 1.25. It could be anywhere from 1.2 to 1.4, depends on your lender, depends on the lender's risk to you, the lender's risk to the market, the lender's risk to the property as to what that's going to be. I'm assuming I'm going to have 1% in loan points. This was done in a couple of years ago. So I've got interest here at 3.45. So let's make this more appropriate for today. Let's do 6.75. I got loan amortization of 30 years. Now, if this is going to be agency, that means that my loan amount needs to be over $1 million to be able to get there. And then I can have 10-year loan term. But if it's a permanent lender that's going to loan on this and they're not agency on an older property, and this is probably a 1960s or 70s product, you are not going to get 30 years amortization. I want you guys to be aware of that. I know everybody only talks about interest only period, balloons, and 30-year amortization. Nobody ever talks about what you actually have to pay in amortization if you go to a credit union or if you go to a regional bank, even a national bank where you're getting permanent debt or long-term debt. They're going to include in the age of the property as risk. So what'll typically happen is on a pretty average basis, now it depends on the lender, it's going to range between 15 and 25% amortization for, again, this is permanent debt. What's pretty average is 20. I can't tell you how many times we ended up getting 20-year amortization quotes on product that is built in the 1960s and 70s. So I've got really good data to align with that. Now, this was 3 or 4 years ago and backwards all the way to the Great Recession. I have not reached out to lenders to talk about loans today. So I would assume that is still the case, that they're not going to go a full 30 years, that they're going to try to get between 15 and 25. And honestly, it's all about the lender yield. The lender has a yield in mind that they want based on the risk of this asset. And so they're going to adjust either interest rate, amortization, or loan points in order to get that yield and the loan term. Okay, that all makes sense? I know we weren't here to talk about loans, but it's important to have this information in here. All right, investor data. Now, there's 3 things you guys we've not talked about. in any of the courses because I don't get into after tax and we don't get into capital accumulation. Those are advanced strategies. We only talk about your discount rate before tax. And if you remember in the definitions and acronyms, your discount rate is the internal rate of return that you're expecting to get for this property. So when your discount rate and your internal rate of return are the same, then your net present value is zero. You're going to see when we come down the model that net present value can either be negative or it can be positive. In this case, it is negative, which means that in order for these cash flows, if my numbers are right, and I'm assuming these cash flows based on my assumptions, current year one, and then my assumptions from year 2 through 6, we always look at year 6 to sell in year 5, then that means I have to pay $547,981 less than the asking price in order to achieve a 15% internal rate of return. That's what net present value does for you, okay? So that's a little visual of what you guys didn't see when we were doing the definitions and acronyms.
Does changing the interest rate affect that?
No, because, well, changing the interest rate would, let's see.
Affect your payment.
Let's go back to 3.25. Yep, interest rate affects it because it affects the internal rate of return, the overall return on the asset. Okay. Good question. Okay. So if we're doing after tax, then we need this information. All right. We're going to assume purchase price for assessed total because we are assuming year one is going to increase to the new tax amount. The lender is going to assume the same thing. The assessment for land and building you can get from the tax assessor. And most states are pretty consistent throughout their municipalities. Alabama is that way. Florida is that way. I don't know about Texas because it's non-disclosure. North Carolina is non-disclosure, although more people disclose in North Carolina than disclose in Texas. But this is a percentage. So if 6.95 is the purchase price, you'll see that I've got 80% is the building and 20% is the land. We cannot depreciate land. We can only depreciate the building. So here is our depreciation schedule for commercial and for residential based on straight line and based on mid-month convention. Do not ask me what any of that means. We're not going to go into that today. Those are advanced after-tax strategies, and we don't really teach after-tax. I just have after-tax in my model, so I have to have this information in here, okay? So it's a residential property. So if I was to change that to commercial, it changes it to 39 years. So residential, it's at 27 and a half years. Tax rate is your tax rate, your ordinary income tax rate. Then there's capital gain and recapture. So gain and recapture really are based off of your normal income. So if your normal income tax rate is only 18.5, then your capital gain is only going to be 18.5 and your recapture is only going to be 18.5. So it's ordinary income up to 20% for capital gain and ordinary income up to 25% for recapture. All right. That's how we calculate after tax, both during operations and at the sale of the property, and then any capital improvements. So all these grays are just fill in the blanks. Then we come here to potential gross income, okay, increase in year 2, 3, 4, 5, and 6, because we look at year 6 NOI to determine year 5 value. No, I know that the other gurus do not teach that. But if you were ever to take a financial analysis course in college or through CCIM or through IREM or SIOR or any of the national organizations that actually understand underwriting, you will find out that you use year 6 projected NOI to determine year 5 value, because we actually don't get the right to the seller's information. That in year 5, the seller, that's their operations. You're going to operate differently in year 6. So we have that projected year 6, which really is year 5 normalized for year 6, including the additional, what we think the income growth and expense growth will be per the financials that we see. So when you see us normalize, we're really getting to that year 6 number on the back end without actually showing year 6. I hope that makes sense. Confuse anybody on that? Okay. Nothing in the chat. So we talked about this. This is the income increase. Here are the other expense increase. Notice they are all the same. When I do my assumptions, we talked about this. Income growth and expense growth. I don't care what you put. I could put 12% here as long as you put 12% here. All right. Now, this prevents manipulation of the model, but where you do now have the opportunity to manipulate this model is by adjusting vacancy. So notice I'm year 1, 25%. So I'm projecting in year 2, I'm going to have over half my units done and up to market rent. So in year 2, I'm at 15%. And then by year 3, I'm at 9 and I'm starting to stabilize. And so now, as the property management company gets a little more efficient, gets a little bit better at the market, it slowly comes down to year 5 where it is at 7%. So we go from 25 in year 1, 15 year 2, 9 in year 3, 8 in year 4, 7 in year 5. All right. So this is a manipulation of the model because this will cause your NOI to go up because you're lowering vacancy, even though income and expenses are the same. You guys understand that? Does that make sense? I'm going to assume yes. I'm just going to put you guys all back up so I can see heads nodding. All right.
I don't get it.
You don't get it. Okay. When you look at a financial model, let's look at the discounted cash flow down here. So here is your T12. Okay. Let's just assume that all your income is here. All your vacancy and credit loss is here. All other income is here. All operating expenses are here. Okay. So we got potential rental income, gross operating income, operating expenses, net operating income. All right. The way to manipulate this NOI without manipulating the income or the expenses is to do it through the vacancy. Notice how the vacancy trends downward. As vacancy trends downward, NOI trends upward. Do you see that? Even though everything else stayed the same.
Right. Okay. Got it.
Okay. So that is an opportunity to, and I'm not telling you to manipulate. Do not use it to manipulate. But we can be pretty doggone sure that we can operate at these numbers between our business plan and our operating partner, our property management company, and what they're seeing. Now, of course, a SWAN event, a financial collapse, a change in the market will change this information, obviously, which is why we do stress tests. Okay. Make sense? You got it now, Richard? Yeah. Okay.
Yes.
So that's it. This is all I input. Okay. It wouldn't take me 10 minutes to input this. I should already have all this information. Okay. Once I've got this information, and if you don't want to do an after-tax calculation, you don't even have to do any of this information. Okay. I'm going to stay away from after-tax safe rate and reinvestment rate because that has to do with capital accumulation. You'll see it at the bottom. Maybe I'll do another class in the future on how to utilize that. So here's my calculations from what we inputted. We got our price, we got our acquisition fee, our loan costs, minus our loan. Now, let's talk about the loan, maximum loan amount. So if my debt service coverage ratio made it in year one, I could get a loan to value of $1,271,250. But it doesn't. It is capped off at a 1.25 debt service coverage ratio, which means my maximum loan amount is only $828,659. This is one of the biggest calculations that every single financial model in the market does that it's missing. Nobody does minimum of. Nobody, not one single model. I've looked at them all. None of them do maximum loan amount. If only. Then you wouldn't have syndicators going, why won't the lender loan me 75% LTV? Oh, it's the risk in the market. That's what it is. No, idiot. It's because you don't know how to underwrite. It's because your numbers are freaking stupid. Okay. You've got to have that minimum debt service coverage ratio in order to get that 75% loan to value, if that's what you're looking for. If you're looking for 80, it's going to be even worse. Okay. So we can see our max loan amount is 828. So minus loan of 828 plus capital reserves. So you can put whatever reserves you want. If you only want 500 in capital reserves per unit, that changes the number. Okay. If you want 5,000 per unit, that changes the number. All right. So in this case, I had 2,000. So we want capital reserves of 58. Here's loan reserves. When I created this, we were in the middle of COVID, and we had Fannie Freddie was requiring COVID reserves, if you guys remember. But it's always good to have some kind of loan reserve in here. So in this case, I have loan reserves equal to annual debt service. See how annual debt service is 64,445? So that gives us 12 months of loan reserves. Okay, you can change this to whatever you want to. And then, of course, our capital improvements, which we got from up here. All right, so all of these are calculated. Anything gray, we input. We already talked about the loan amount. So now if we look at the effective cost of borrowing, okay, our annual percentage rate is 6.9, even though we have an interest rate of 6.75, because you have to include that 1% fee to the lender. That gets included in there. The actual lender yield, the lender is going to make 7% on this. So if the lender's discount rate is 7%, then you can take this information, you can look at this, and you can say, oh, you know, I really need a lower interest rate, but I can afford to pay some upfront points a little more. So if you come up here, you can look at this and you can say, okay, well, if the lender wants 7.5% yield, and they've told you that because you can ask them, then I can come up here and say, all right, well, if I lower my interest rate to 6% and I increase my loan points to 1.5, will that get me where I'm trying to go? Actually, it went down. That should have included the loan points. What's my field here? 18, D18. Oh, it didn't include my loan points. All right, I might have to readjust that because that lender yield needs to include the loan points. So forget I just said, well, actually, it probably does because I went really low. So we were at 675. Let's go 6.6. And we increase this. Yeah, it's bringing it back up again. So it is definitely doing that. If I go 6.75 where we were before, yeah, 7.12. So it is including that. So you can manipulate these two numbers based on your goals in order to get the lender where the lender needs to be. Does that make sense? That gives you negotiating power with the lender. You guys good on that? All right. See, this is you don't see any of this information in any of those stupid guru models. All right. So based on everything I've putted so far, my average rent per unit, my actuals and financials, and then actually really that's it. My purchase price, my costs, my loan, everything. My acquisition cap rate at this point is 4.76. I get a year one cash on cash of 1.35. So, hey, I'm cash flowing a little bit. At least it's not negative cash flow. My operating expense ratio and then break even occupancy is 71%. So if I come down, we can start to see what the model looks like. And I put this in here. Really, I should probably do this. Kind of give you an idea. So in year 2, you can see that the cash on cash does go up. And in year 2 through 5, it gives you an idea of where your cap rate is based on year 2's NOI and what you purchased the property for. So that $1,695,000, if you purchased it at that, it's year 2's NOI divided by that purchase price. Year 3's NOI divided by the purchase price. Year 4's NOI divided by the purchase price. Okay, so here's where we can start to determine if I'm looking for a 7 cap or a 6 cap. So if I'm getting a loan at 6.75, I want at least a 7 cap. If I'm looking for a 7 cap and I'm willing to buy it on pro forma, can I get at stabilization? And I'm assuming year 3 is stabilized in this model. At stabilization, can I have a 2% spread on that cap rate? So if market cap rate 7, I'm good looking for a 7. By year 3, when I'm stabilized, if I'm going to buy this on pro forma, I need year 3 to be at 9%. That's that 2% cost markup spread. Does that make sense? I'm going to show that again. It's going to be a little clearer when we get to the other financial model. Okay, so that's what this information starts to tell us. We can see here that when we go to sell the property, we bought it for $695,000, and if we stayed like we're doing, we can only sell it for $1,849,000. We got selling costs of $110,000. We got a mortgage balance of $777,000. So sales proceeds before tax are $968,09. So this gives us good sales data when we go to sell the property in year 5. And again, remember, we don't have any investors in this deal. This is for a joint venture. Okay. So we're not looking at waterfall structures or anything else. So we can look at the before tax internal rate of return and modified internal rate of return. I did not include the modified internal rate of return because I do not want that going into your brain housing group and exploding your brain. There's also XIRR and MIRR, and we're not even going to remotely go there. And you can see through the reinvestment rate up here. So if we have this reinvestment rate of 10%, so if I take my cash flows and I reinvest those cash flows into another multifamily deal that's going to get me 10%, because nothing else is probably going to get you 10%, or maybe a self-storage deal or a triple net deal, depending on what it is you're doing. If I reinvest those cash flows at 10%, then I will have accumulated in capital. You can see it cost me $1,201,000. I will have accumulated $1,282,659 by the end of year 5. That does not include the sale proceeds. That's just reinvesting at these cash flows. Okay. That's why I didn't want to go into that, because it gets really complicated when we start talking about capital accumulation. But that information is on here. So I just want to make you aware of it. Here's the important stuff. Again, that nobody provides on their financial models, except there is one. Bob Woodward, who built the deal analyzer for David Lindahl. So if you are familiar with what is the name of their community? RE Mentor. So if you're familiar with RE Mentor or David Lindahl, he's got a partner. His name's Bob Woodward. Bob Woodward built a financial model based off of CCIM fundamentals. It's the closest I've seen. It still does not do minimum loan to value and debt service coverage ratio. And I've asked him why. He just said, I forgot to put it in. And he said, it ain't worth me going in and putting it in now. It cost me too much to change it. But he does have in net present value. So it is the only one I know of all the models that has net present value. And it should, because David Lindahl touts the strike price, and net present value will tell you what your strike price is based on your discount rate. Okay, does that make sense? Richard, you look confused.
You're throwing out a lot of stuff right now.
This is underwriting, baby. These are
Yeah.
the fundamentals. And this is, see, the problem is none of your other financial models give you this data. So you guys are seeing this kind of data for the first time. And that's why I don't really, I don't aspire to you guys using my model, because it is overwhelming. It's got so much information. I mean, the inputs are easy. Inputs, less than 10 minutes, and boom, you got the inputs in. The problem is the outputs. You're going to start looking at this and you're going to be going, oh, what the freaking frack am I looking at? So that's why I hesitate utilizing this for the community, even though it's there for you to download. I just don't teach how to use it. This is the first time I've ever taught how to use this model. Okay. So as we keep coming down, once we now know that we have to pay $552,121 less than the purchase price. So if purchase price is $1,695,000, so if I go equals $1,695,000 minus net present value, tab. Oh, it's because it was negative. I needed plus. Stand by. I know I can only pay $1,042,000. Whoop, it says per square foot. That's funny. I know I can only pay $1,142,879 for that deal. That is your strike price. That means that's my no more than purchase price based on a 15% target, my discount rate, my target internal rate of return, that target yield for me. In order to get that, I cannot pay any more than $1,042,879. That's what net present value does for you. Yeah, exactly, man. Mine's more simple than all of them. The problem is it gives you more information except for investor information, so it can confuse people. Okay, so that's net present value. So now you guys have seen it firsthand what the heck it is. And then there's after tax, and I'm not going to go into after tax MIRR, after tax mortgage analytics, your financial leverage, and then of course your effective tax rate. Okay, so based on the financials we put in, this year one information, I can only pay $1,142,879 for this property in order to meet my discount rate. So if I look at this and I say, okay, where am I in the market? If I'm in a down market and we're in a buyer's market, I'm submitting an LOI, and I'm probably submitting an LOI at $1 million, because we never offer our strike price right off the bat. We're negotiators. Okay. We have to have room to move. And I wouldn't be afraid doing that. In a seller's market, I'd leave it alone. I'm not going any further than this. I'm moving on, because there's no way a seller's entertaining this in a seller's market. Does that make sense? That's how I can use this data. Any questions on my underwriting workbook? That's back of the napkin with actually, honestly, it's a full underwriting model, but it works like back of the napkin. If I'm just JVing, I have every piece of information I need at this point, because in JV, you're pari passu, meaning what I put in is what I get out. So if I know that I need a total equity of $1.2 million to purchase this asset based on these cash flows and that purchase price, then if I'm bringing 3 million and 3 other guys are bringing 3 million, then we're 25% equal partners. If I'm only bringing 100,000, wait, did I say million? If I'm bringing 300,000 and the other 3 are bringing 300,000, that's 1.2 million. You're equal partners. Okay, 25% each. If I'm only bringing 100,000 and the other three are bringing the other 1.1, and they're equal, then the other three will be pari passu, equal shares of 75% of the deal, and I'm equal share of the remaining 25% based on my input. So it adjusts based on what you put in. That's pari passu. What you put in is what you get out. So if I only put in 12.5%, then I'm only entitled to 12.5% of the deal. That's how JV partnerships work. You can incorporate through an agreement of the other JV partners, sweat equity, but they're going to want money in too. You're not going to get away with, just sweat equity, but they will give you some value to sweat equity, and they will water down their investment in order to give that to you. So you may be able to come in 100,000 and they each come in at 300,000 for total partners and still be equal partners of 25% each based on everything you're going to do in the deal. Go ahead, Richard.
Dave, if everybody's throwing in that amount of money, you don't need a loan then. You actually own the property.
Well, at our strike price, but if you're buying it at $1,695,000, you still need debt.
Right. But at your strike price, that changes all these numbers.
So yeah, but if I come up here to my strike price, it changes everything else too.
Right.
Okay. Now I only need 649,000. Make sense?
Mm-hmm.
Okay. That's how you use this. Questions? All right. Let's go look at synthesis. Where'd you go? There you are. All right. So here's synthesis. Same property. Okay. Same 29 unit, same cash flows. Remember I said average effective rent is $563,000. We did $200 a month other income, 29 units, purchase price of $1,695,000. Okay. I went to the other deal and I looked at what were my expenses per unit, figured that up and threw that in here. I want to walk in, actually, in this case, I really want to walk in cap rate of 7% because our loan amount is going to be 6.75. So I'm going to change that. And economic vacancy of 10, meaning physical and credit loss. This does not include the loss to lease. All right. Because we don't have loss to lease because we got average effective rent up here. You understand that, Richard? So remember on the other model, we were 25%. In this one, we're only 10. Okay. So that'll tell us that here's my data and it's pretty close to the other information. Actually, that's a little low. I'm not sure why that's there. And it could be, because I went up on, is it because of the cap rate? Shouldn't be. No, I didn't think so. What'd I change? I changed the, what did I change? Vacancy. That's what I changed. Okay. Because this was at 216. So if it's 8, what happened? Something changed. This was at 216, like 261 right there. It's because I'm using, okay, never mind. I know why. It's because I'm using this number. So these are your actuals. This is what our potential is. So based on your P&L that you got, your T12, these are the actual numbers you put in. These are the only input fields. Okay. Anything blue in this model is your input field. Remember, gray in mine is your input field. So total average effective rent, average income per unit, additional income, unit count, 6.95 price, expense per unit, walk-in cap rate, economic vacancy. All right. These are actuals. So based on actuals and wanting a 7% cap rate, that means I can only pay $915,000 for the property, not $1,695,000. Okay. That's all this tells you. You don't really know any other information other than that. So to me, this isn't enough data, but it's a quick, Just a couple of minutes, throw it in, see if you want to continue to move forward. Then if I
Question.
say, go ahead.
So walk-in cap rate, I know that you just mentioned it, but like I'm lost. So
Walk-in cap rate is on actual financials. I'm not purchasing this property under a 7% cap rate.
okay, it's not like a normalized cap rate that you got
No.
from CoStar, you
Nope.
know, for that market.
Nope. This is my risk. And knowing I've got to pay 6.75% in loan interest, in order to have positive leverage, I got to be greater than my loan amount. So I'm going a quarter, 25 basis points higher at 7% cap rate. I will not purchase this property for less than a 7% going in cap rate on existing financials. In order to do that, I have to pay $700,000 less for the property. Actually, almost 800. Make sense, man?
Okay, thank you.
Okay. So now you remember I told you that if you want to purchase on pro forma, there's a way to do it utilizing data, utilizing the financial information that you have. And that's the way developers do it. It's the way institutions do it. And that's through a cost markup spread. So if I know in year 3 that at stabilized, all my rents are going to be at $750. My income is going to be $200. I'm still 29 units. I'm still at 1.695 million. I still have the average expense per unit of 4050. Okay. That stabilized cap rate now would need to be 9%, not 8%, because I want a 2% cost markup spread. So in that year 3, it would need to be 9% with an economic vacancy of 10%. So now you can look at this and you can say, remember one of our tests was that operating expense ratio. We can say that our pro forma isn't out of range. We're between that 45 and 55% operating expense ratio. So that I'm good with. But now, in order for me to purchase and get these numbers, so if I'm buying on pro forma, if I'm buying to year 3 stabilized, to be competitive, I can only pay $1,363,000 for this asset. That's what this says. Okay. So obviously more than actuals, because actuals are a heck of a lot lower than your pro forma. But it is saying that if I want to buy on pro forma and I want a 2% cost markup spread, so at year of acquisition, it was a 7 cap, which means in year 3, I want that 2% cost markup spread. It needs to be 2% higher. So it needs to be 9%. So if I'm looking for a 9% cap rate of what I purchased the property for, based on year 3 stabilized NOI, I can only pay $1,363,000 for this property. Does that make sense? That's what this back of the napkin does for you. That's all it does. It doesn't give you any other information. And this is synthesis. Questions? Obviously, much simpler than mine, but nowhere near the data you need to make a decision. What it can tell you, though, is, again, if you're in a seller's market, you're probably not putting an offer in on this property. I can leave it alone because you're too far away. If it's a buyer's market, now we know I need to be somewhere between 915 and $1,363,000, depending on my risk and how much am I willing to go pro forma versus actuals. Okay, so I can make decisions based on the numbers. Everything is data driven. Does that make sense? What I don't like about this is I don't have any way to change, because expenses per unit in year 3 are going to be higher. Now I can go think, all right, 3%, blah, 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 blah. Effective rent per unit at $750 is today. 3 years from now, I'm going to have 3% annual per year. It's going to be higher. I can make those adjustments manually where my model does it automatically. But you'd have to do that in order to do this. So it would take a little bit more time. So I call this a 10-minute back of the napkin because it'd still take you about 10 minutes. The problem is it just doesn't give us enough information to make a decision. My opinion, for me. Yay, nay, maybe say, y'all good? Richard, you still look like this is way over your head. You good?
Quick question, David. Sorry, I came in late. So pro forma is basically kind of like a future approach of the deal, on how it's going to look in the future.
Correct. It's speculation. Is what it is.
Speculation. Okay.
Right.
And
which is how everybody has purchased the property in the last 3 years.
and these numbers are coming from the broker or for the market, all that, no?
I don't take anything a broker tells me. I get it from the actual financials myself and from doing my own market analysis and what I know about the market.
Thank you.
Yes, sir.
Question.
Yes.
Yeah, back to the walk-in cap rate. I came late, so I don't know if I missed that information, but how do we determine the walk-in cap rate?
It's what you want it to be. In this case, it's what you want it to be. Now, once you input everything correctly, once we get into synthesis, it's going to tell you what the walk-in cap rate is. And you have to make a determination, is that acceptable to you or not? In this case, I'm saying I don't want any less than, I am not willing to pay anything less than a 7% in this case, because my loan's going to be 6.75. And in order for me to get positive leverage, my cap rate has to be higher than my interest rate on my loan. So in order
Okay,
to
now I get it. That's based on the loan,
It's
the
the
mortgage.
risk. Yeah, it's your risk. It's based on your risk versus your loan. If you don't have a loan, then it's just on your risk, because then it doesn't matter, because there's no leverage. So you don't have to account for leverage. The loan is what gives you leverage. The loan allows us to get a higher rate of return if we buy it right than if we pay all cash. So if my discount rate is 7% and I'm paying all cash for the property, then my going in cap rate needs to be 7%. If I'm an institutional investor and I promise my investors a 3% return on their money, then I can go all the way down to a 3 cap. And it doesn't matter because there's no loan. Make sense?
Got it. Thank you.
Yes, sir. We good? Roger, you look like you had a question.
I was just thinking about the information provided here, and you're basically doing this analysis here just to say it doesn't make any sense at all. I don't need to look into this deal any further, or
Right.
There's some potential here. Now we need to do some more in depth to see where it does make sense.
Correct.
That's the whole point of this,
The
right?
whole point of this, right?
Yeah.
When you get really good at doing this, you don't need a model. You can do it in your head.
Right.
All I need is a rent roll. Give me a rent roll and I can determine value very fast and what I'm willing to pay for a property.
Mhm.
Doing it a long time. I've been underwriting for over 10 years. So that comes with experience.
Yeah.
Okay.
Yeah.
You guys ready
Okay.
to move on? So does anybody have a T12? I'd prefer a T12 so I can show you how to do a T3, or a profit and loss that they want to use to input into the synthesis analyzer. So this was from the Presidio that we did during the case study. All those cells are already inputted, but we can come in. You can see there's tabs at the bottom. Can you guys see this okay? Let me increase this. Well, that didn't increase the tab. So there are tabs at the bottom of the synthesis analyzer, just like any of those other stupid tools. The one for actuals and unit mix, this is where you want to start. So here's where you put in the actuals from the P&L or from the T12. And here's where you put in the actuals from the rent roll. Remember, anything in blue is what you input. Once you've put these in, we can then go to the dashboard and we can start putting in our other information so that we can start to get to some decision criteria. And just like the other stupid freaking deals, you got red, yellow, green, all kinds of crap. In this case, all it's saying is You've said you want an 8% pref. You aren't going to meet it with these financials. That's all the red's telling you here. If you put in 8% and it does meet it, it would be green. Okay. So I'm okay with the way they use the colors here. So you can see down here, they're just warnings. You got a refi warning, a sale warning, and a cash flow warning based on our inputted cells. Okay. That's how this model works. So does anybody have anything different than what's already been inputted on here?
No, but Dave, I have a question.
Yep.
Not necessarily on this. Sometimes you see these T12 and expenses aren't categorized correctly.
I don't care.
Does that actually, that doesn't actually matter. It's just that it's there.
It's just that it's there.
Okay.
Yeah. I don't care. If you really want to see how it gets categorized, this afternoon, Charles Seaman will be doing his underwriting workshop that he does every Saturday. He actually shows you how to categorize all those expenses. Okay. I don't care. As long as the expenses are in there, it doesn't matter to me. Good question. Anybody else? Okay. So let me show you what the T12 looks like. We can at least do that. I got to go find it.
There's the T12 to this.
Yes, correct. The T12 to this. Monthly workshops, underwriting, Presidio. Financials. Trailing 12 month. So let that come up. Okay, so here's a T12. We all know what this looks like. We looked at this in great detail before. Okay, remember we talked about the write-off of the bad debt really should have been up here in the vacancy and credit loss. They're manipulating the model, putting it down here, and we talked about that when we looked at this. All right, so what I really want to show you here is notice that I have some extra line of stuff. You guys know what that is?
The average
Of what?
of the line item across the 12 months.
So it's across the last 3 months. That's the T3. It's really easy to calculate. All you got to do, and there's a couple of ways to do it, but this is the way I like to do it, is you'll see up here equals, okay? It equals K8, and you can see here, K8 plus KL plus KM, so the last 3 months, divided by 3, okay? Because there's 3 months, so we want to average those out, divide it by 3, and then because we're annualizing that number, we have to multiply it times 12. Okay, that's it. That's all it is. So instead of 2,942,000, we can actually get 2,950,000. So we get an extra $8,000 in income on this from doing that T3. This is what the agency lenders allow you to do when you are looking for agency debt. There are some other permanent lenders, not all, but there are some other permanent lenders that will look at a T3. They want to look over the last 3 months. How has this property performed? Income only. Okay, so you do this from potential rental income all the way to your gross operating income. I'm sorry, to your utility income is other income that shouldn't have been included. Did I include it here?
You just drag that down, that column.
Yeah, you can.
Formula changes, yeah.
Right, you can. But what you're looking for is your rental income, your vacancy and credit loss. Some lenders will allow you to do other income, some will not. You just have to find out from them which ones you want. But that will give you, so you can see here, we have an additional $200,000 of income from doing a T3. Okay. So in this case, it helped us. Now, the reason it helped us is because sellers are smart and brokers are smart enough to let the sellers know, hey, stop spending money in the last 3 months and increase your rents to absolutely as much as you can for the last 3 months so that we can improve our NOI for the asset. And they work very hard for them to do that. A good broker, that's what they'll do. They'll get the owner to stop spending money on maintenance. You know, you got to do the stuff that matters, but the stuff that was scheduled probably isn't going to happen. And on the income side, they're going to start adding as much rent and as much fees and as much as they can to get that T3 up. Okay. That's manipulating the sale, but everybody does it. What you got to be careful of is the IRS doesn't catch you doing it, because they're pretty smart fellers if they catch you on that. So that's how you do the T3 on the T12. So really all we're doing, what I like to do is I like to just take the high level information. So if we look here, once we get past other income, we have payroll. So I'll just take total payroll and put it on the model. I'll just take G&A, general and administrative, and put that on the financial model. Marketing. So just the total. So we don't end up with all these line items on your financial model. You only put in the ones that are categorized. We talked about that a minute ago, within the model. And again, for me, when I'm doing the underwriting, it doesn't really matter. Towards the end, I might clean it up a little bit, especially if we're looking like we're going to purchase this asset, because the lender is going to want to get it cleaned up at that time. But when you're getting towards an offer, it does not matter. So if we reduce this and we go back here and we go to actuals, you can see that we have all the actuals here, and that there's even a couple of spaces here for you to add if it wasn't included on the T12. So if you've got something in there that isn't included here, you can put it here. All right, does that make sense? So these are all the inputted cells from that T12. Okay. And it gives you what the per unit per year is for each one of these. But the blues are your inputs. Now, CapEx reserves, 15,000 on a 200 unit property is probably not enough. How many units is this thing? Oh, it's 100 units. No, this ain't right.
202 units.
This is different. These are different numbers, I believe. Hold on. I know this isn't 100 unit. Where's?
There's 202 units at the top.
Yeah, 202. So why is there only 100 here? And we'll change that one to 51 and that one to 51. How about that? There we go. I was looking at another, I think I was playing with this with something else afterwards. So these rents and everything here are all going to be off. So it's going to make that data look even worse, although it should make the income look a little better. Yeah, but not that much better. Okay. So that's how you input everything. You can look on your rent roll. So if we pull the rent roll, and we come all the way down to the summary of the rent roll. In this case, this rent roll does not give you the 1 beds, 2 beds, 3 beds, and the different floor plans and which is there. So you can go to the OM in that case. So if I come out of here, go to the offering memorandum. Need to find the unit mix. That's the renovation. Market data. Comparables. Where's my unit mix? Historicals. There it is. So here's my unit mix. Okay. So I would input all of these into those cells. So if I'm gonna move this to the side. Oop, I gotta minimize you guys so I can see it. There it is. And come back to our model. So we have 3 1 bed, 1 bath. We could add more here. And the unit prices are different. So if I go Control C, Control V, Control V. So I got my 3 1 bed, 1 bath. I've got 3 2 bed, 1 bath. Whoops. Control V, Control V. And I've got 3 2 bed, 2 bath. So let's take this one. It wouldn't let me go up.
Don't you already have all the breakdowns there?
Well, the rest of these are not applicable. So I got my 1 2 3 1 2 3 1 2 3. So I got them all now. So just to keep it simple, we'll leave it like that. Whoops. And there's no studios. So now I can come in here and say, okay, how many is the first one? There were 3 of them. The square foot is 854, and it's actually 854 for all 3. Market rent was 11. So current rent, target rent. See, the problem is this doesn't give us the current rent. It just gives us the market rent. So current rent, I'm going to go 200 below it for each of these. So let's say 983 for the first one and 1183 for this one. Then did 200, so 1066, 1266, too many 6s there. Okay. How many units for each of these? Wait, what'd I do? Oh yeah, okay. So the second one is 32. And the third one is 13. And the third one has 1189 and 1389. 1189, 1389. You see why you want to do back of the napkin first so you don't waste your time doing all this stupid stuff. All right, so next one, 2 bed, 2 bath. Where's my 2 1? Oh, my 2 1s up here. Here we go. 2 1s. There's 3 of those. 40 and 19. 40, 19. And they're all 954 square feet. Okay, and rents on these.
Is the 19 supposed to be 2 baths, Dave? Because you have 2 bed, 1 bath, 2 bed, 1 bath.
Right, I have 3 of them. So 2 bed, 1 bath. 2 bed, 1 bath, 2 bed, 1 bath. I have 3. I got 3 of every floor plan, total of 9 floor plans. See them? 1 bed, 1 bath, 1 bed, 1 bath, 1 bed, 1 bath.
Okay, I didn't know if it was
2, 2, and then 2, 2, 2, 2, 2, 2. Okay. So rent is on the 2-1, 1102, 1302. And on the next one, it is 1153, 1353. And on the last one for the 2 1s, 1311, 1511. All right, one more to input. The 2 bed, 2 bath. Let me guess, 3, 59, and 30. Each one of these has 3. 3, 59, and 30. Did we get 202? We got 252. Ah, that's why. There we go. All right. So the first 2, they are all 1091 square feet. This is the boring part, guys. Right. And the first one is 1239. $14.39. Second one is $12.90. $14.90. And the last one is $14.48. All right. Whoa. Control Z. Control Z. Almost screwed that up. All right. So now we have our rents correct inside the model. Let's look at the T12 again. If those are wrong, these inputs here are probably wrong on the T12. Let's find real estate taxes. Oh yeah. 448, 528. And of course we want to normalize for that, but let's put that in there. Insurance 166,977. Contract services. Let me look on this T12. I'm gonna put all of that into repairs and maintenance, so I'm just gonna put 0 for that. For now, trash removal. That's probably gonna fall under. Where's utilities? Let's see. Yep, trash is under utilities, so I'm going to put 0 for that for now. Electric, I'm going to put 0. Gas, 0. Water, sewer, 0. And for trash removal, I'm going to put utilities. Legal is going to be under general and admin, which is here. So we're going to put 0 for that for now. Management, we're going to leave. Repairs, we're going to leave. General admin, payroll. Advertising should have its own. Let me see if it does. Yep, marketing, there we go. And then grounds, maintenance, and landscaping is going to be under repairs and maintenance. So that'll cover everything. So we're not doing contracts. Let's go to utilities. Okay, if I go to utilities here, you can see total utilities is 191, 183. And that's how I'm finding these. So you just saw that. 191, 183. We're not worried about any of the rest of that. Management fee. So I'll go find the management fee, which is right there. And that is 77,951. And then repairs and maintenance. 150,924. G&A. 45,853. Payroll. 317,709. Advertising, or in this case, marketing. Not going to worry about changing it on there. 23,659. And that covers everything. Okay, so we have 1,422,784 in total expenses. So let me verify that real quick. I got 1,418,177. So something's a little higher than it should be, and it could be because I didn't round anything. But that's not a big deal. There might be one little thing that was missed on all this. Let's see. 443,918. That's what it is. 443,918. There we go. Okay. So we can see here, and again, I didn't round anything. There's our total expenses that we can compare that off of. Okay. So we're right in line. So we have our income, we have our expenses. Gross potential income is going to be, you're going to need to multiply this number. So, oh, let's do it this way. We know we have 202 units times what were our market rents. Here was our target rents. Gross potential income is going to be times 1438. So times 1438 equals 290,476 times 12 equals 3,485,712. 3,485,712. Right? Vacancy and credit loss. You'd have to look at the market. That'd be part of our assumptions. I'm going to leave it at 9% because Allen, Texas has got, it's an up and coming area. It's where the Dallas Cowboys practice facility is located and now headquarters. So 9% between credit loss and physical vacancies probably going to be okay. There's probably going to be some concessions, loss to lease, bad debt, but I'm including that here, so I'm not worried about it. And then, of course, other income we can come back to. Now, remember, and I'm just going to put the total on here so you guys can see it without trying to calculate everything. But you remember I told you in other income, if I open this all the way up, other income, you're going to want to take out stuff like application fees, unauthorized pet charges, all that stuff that's just intermittent. You're going to want to remove it out, and anything that's consistent, you're going to want to keep in there. Okay. And all this utility income should be part of that. So I'm going to add 161,489. Actually, it's let's add this one. So I'm going to put equals this plus this tab. So 213,566. Oh, I guess I could have just did the 226,382. Because I T12 or T3'd these. So I'm just going to use the smaller number, 213,566 or 556. So here is 213,556. Okay, so now we have our model, CapEx. What do you guys want to put away for CapEx reserves? You tell me. Give me a number per unit. It's a fairly new property. I think it was built in 2018 or 2019.
500 a unit?
Okay, I got one for 500. Anybody else? No? You guys just don't want to play today, or you all agree with him? All right, well, let's do, I think it's low, but
It's a bit low.
it is a new property.
Yeah.
500 times 202 equals
101.
101,000. Okay, it's better than 15,000. So let's put 100,000. I think the lender would make you increase that, but we'll put it there anyway for now. So we all good? You guys agree with everything? So you can see how long that takes to do all that. And you'll notice that when Charles does it, and he does it every single day, he's so used to doing this on the syndicated deal analyzer that it doesn't take him much time. But I mean, hell, that took, well, honestly, it only took about 20 minutes between all of it, but still took time to put it all in there. So now we have our actuals. So now we can go to the dashboard, and we know that the whisper price was 46 million. So we can put that in there. We got our information about the Presidio, Allen, Texas, just general information about the property itself. Okay. Everything else comes from the data we've inputted so far. So earnest money deposit. Okay. You can put that here. And it'll tell you what the percentage is of the purchase price. So here I put 460 because that's 1% of the purchase price. Pretty average, although not competitive, but we're getting out of a seller's market. What the reserves total out to be, all the information, including acquisition fees. So acquisition fee, what do you guys think we should put for an acquisition fee on a big deal like this? $46 million project, what should our acquisition fee be?
2%?
Broker brought it to us. We did not have to go find it ourselves. Roger said 2, Richard says 1.
2.
Okay, we got 2, we got 1. Any other thoughts? All right, well, we'll just leave it at 2%. Asset management fee. Typically, it's 2% of income. It's negotiable between you and your investors and the partners. Everything's negotiable. Matter of fact, when I did my syndication that I did in Texas, in Longview, Texas, we did 5% of the NOI, not 2% of the income. It made the investors more comfortable that we were willing to be responsible for the expenses as well as the income, not just the income, which is what everybody does today. So we were able to get that extra point because we were going after the expenses. And that way, if we did better, we actually benefited from doing better. And if we did worse, we took a hit for doing worse on the expense side. Okay, makes sense? So those are our input cells for the project itself. Now we go to the loan data. So what is this? So we can choose here. We're not doing bridge. We know we're going to do stabilized debt. Okay. So we'd like to see a 30% down payment, but I don't think we're going to get it. Let's change it to 25. Okay. The rate's going to have to be, again, we said 6.75 today. But if we're going Fannie Freddie, which we would on this, Fannie Freddie today is 6. We'll leave 6.75 because maybe we're a little bit riskier. For the best borrowers, it's 6.31 today. So we'll leave it at 6.75. We're going to ask for 36 months interest only, and Amber High's at 30, which is very typical of a Fannie Freddie deal. We're not going to ask for a supplement. Refi, we don't need to refi, so we don't really need to worry about this. So we're not going to put that in there because we don't need to refinance. And then refi or exit. So we're not refining. Yep, that took that away. Didn't have to even do all that. Cap rate at refi. So if we're buying today at 7, I'm going to put this at 7.5 because I do believe that now, obviously, this isn't going to work with this cap rate. I do believe that we are going to stabilize between 6 and 8% when interest rates stabilize. I think it'll be on the lower end of that. So I think really anything above 7% is probably going to be okay for cap rates in the next 3 to 5 years. Just my opinion. We're going to ask for 75% loan to value. We're going to sell at the end of year 5. And cap rate at sale again is 7.5. So that's at refi. So that could be just, we're not worried about that. Okay. So now we can start to look at some numbers. So we obviously are negative cash flow on actuals because our break-even occupancy is actually 1.5% more than you can actually occupy in the unit. But it's honestly, it's because of this 7%. So let's put in what the numbers would have been when this project first came out in January. So at that time, rates were what? 3.75. And refi at sale would have been, they would have gone 50 base, let's say 4.25 is what they would have assumed. So let's put that in there. So now we got break even occupancy of 68. We got year 1 DSCR of 1.58, year 1 debt yield of 5.91. So numbers start to look okay at this point. Notice we have no reds. Okay. So based on the financials we put in and the rent roll off existing, now we did not normalize. So let's go back. Who knows what the average increase is for what's Texas? What's their average tax to property value? Anybody know? Is it 2%, 3%? Anybody know that number? No? Well, let's just increase. We're going to normalize because we did not normalize real estate taxes. So let's normalize. Let's just say it's going to be 650,000 because Texas is stupid. Insurance.
Hey,
Yes, sir.
I've got a resource for you on that one. The
Go
real
ahead.
estate taxes. Go to smartasset.com.
Oh, we don't have time to do all that, Josh.
It's super quick, but it's a good one. Okay.
Well, will you do that? Will you go and see what it would be? Thanks.
Yep. I'm good.
Management, I'm going to go ahead. Well, that's pretty low. I'm going to take that up to 3%. So what's that going to be? Still not there. Still not there. There we go, 3%. And then we'll leave everything else the same. So now we've normalized. Let's go back to the dashboard. And we're still pretty good on the financials. So according to what we've got, this deal at obviously a 4.25. So you're buying this thing at 3 point something. What's our going in cap rate here? Let's go to returns. Where's that at? Refi exit. Where are those returns at? There it is. So you're purchasing it at a 3.71 cap based on these financials. So if you purchase this property, these cash flows based on your based on an internal rate of return of, if we go back to the dashboard, actually there's no internal rate of return. You don't get an internal rate of return. Average cash on cash is only 3%. Wow, that's interesting. So What's our loan data? That's the CapEx, closing costs. All right, so we've got annual debt service of $1,293,750 for the first 3 years, and then amortizing after that. So that came out good. Cash flow available for distribution is 712. And we know that in the dashboard, our initial equity raise is 14,665, which is why there's only an average cash on cash. Well, that's average cash on cash over the whole period, not just in year one. So where is our well, returns? That's where it would be. So we've got beginning capital. Oh yeah. So your returns tank after you amortize. So not such a good deal no more. I mean, it's such a bad deal. You can't even get an internal rate of return. Doesn't even give you one. So cash on cash goes down. Whoop. Whoa. Cash on cash goes down because you amortized, basically, which means you don't have any way to get an internal rate of return. So what is our refi exit? What's our sale price? Total sale proceeds of 16,862. We can sell at 51. We bought at 46. That's not very good. Total sales of 16,862. And we owe the investors 14,665. So not a very good return on capital. You guys seen in all this information? Okay. So you can put in your investor splits. We're not going to go over these, but these are other pieces you can put in, and then you can start to look over this whole thing. So when you get the divide 0, it means that because you cannot have a negative internal rate of return, it just won't calculate it. So this deal obviously doesn't work, even though I got no reds, because there's no way that these are being met. So that's interesting. Anyway, that's how you put all this together. So in this case, if we bring this down to, let's say, and I got no way to do NPV on this one, you just start playing with the purchase price. So if I bring the purchase price down to 40 million, let's see what the numbers look like. Still don't have an internal rate of return based on these cash flows. So let's go down to 30 million. Oh, still don't have an internal rate of return, but we got a cash on cash. Internal rate of return might be broken on this. So that should have produced. You got acquisition fee. Purchase 5.7 now. Cap rate. All in year one. Break even is, we should have an internal rate of return on these, and for some reason it's not showing up. The model might be broken somewhere. Well, that's interesting. So if I go back to, where's investor returns? Yeah, cash on cash is looking good. We should have had an IRR. For whatever reason, we didn't get an IRR. It's because it didn't return the capital at the end of year 5. Total proceeds from sale. Yeah, it's not calculating the proceeds from sale. Here's the exit. There's the total proceeds. So something's broke. Hey, what a way to find out your model's broke. So if you're showing a good cash on cash like that, good way to tell where our cash on cash is a 10.23 average, and you're not showing an internal rate of return, something in the model's broken. I don't know what broke. Something in here broke. I'm not going to sit here and troubleshoot it. But you can see that in this model, because you don't have NPV, you'd have to manually adjust it in order to determine what your asking price is going to be, or what your no more than purchase price is going to be based on the internal rate of return target you're trying to get. In this case, we can't see it because the model's broken. The other thing, and I just saw it and just wanted to mention it. Now I can't remember what it was. I don't remember. Must have not have been important. All right. Questions on inputting everything. Now, obviously, you want to have a clean. I did something in this model and I broke it. I don't know how I did it. But let me know if you guys utilize this model and you get some similar result from the download. I'll download the original model that I downloaded from the owner that developed this in the members area, so you'll have it. Let me know if it does this same thing, because the original model may be broken, but I've seen it before. We've had internal rate of return, so I know it was working before. So I've done something to this and broke it, and I don't know what it is. That's the problem when utilizing these models, is you can break things because nothing's locked. So you got to be careful. You got to know what you're looking at. Questions?
Dave, I have a question on the term of the deal, the length of the term. Do you typically underwrite a deal to 5 or 7 years or whatever it might be? What if somebody wanted to hold a deal for 15 years? Would you underwrite to that, or would you still write to the 5 to 7 when you were going for financing and everything? How do you look at it if you've got a longer term horizon?
So the reason people only underwrite out to about 7, and CCIM models actually go out to 10, is because your internal rate of return peaks at around year 7. And then it'll actually decline a little bit and stabilize. So there's really no need to go any further than that, especially if it's a long-term hold.
Ah, that's so interesting.
Yeah, the IRR does not continue to go up for the life of the investment if it's a 20-year hold. It actually is at its peak somewhere between year 6 and 8.
So is that why people typically turn these assets over?
No, what you see is the reason they turn these assets over is because they don't get paid unless they do. Sponsors do not get paid unless they turn these assets over.
Right.
That's why your institutions will hold much longer than 5 or 7 years.
Oh, they will, even though they're still getting a good IRR. It's just that it's plateaued and it's not continuing to go up.
Right, but you got to remember that their IRR is a whole lot smaller than regular syndicators, because most of those institutions are have an investor pool that's only looking for 3 to 6% interest.
Very interesting. Thank you.
Good question. Josh, you ever find out what that tax was? Not that it matters now. I think when I broke this is when I changed the bridge. I did all those zeros. I think that's when I changed this.
So don't save it.
No, I'm not going to save it. Actually, I could just start going.
Yeah, it's it only goes up to 10 million though. So it's,
Okay.
I just found that out too.
Please tell me it doesn't start changing this. Ah, it is. Oh, because I normalized. All right, let's. All right. There we go. Got it. Ah, because I changed cap. Even though we're not refining. All right. So now let's go back and do this again. So let's go back to actuals. So we said 600 here. And insurance, we said 200. And management fee, we said 100. And that normalized. All the
Gotta
rest.
add a zero to the, gotta add a
Yeah,
zero
you-
to the insurance.
You put only 20,000 instead of 200.
Ah, thank you. There we go. All right. So now numbers are looking really ugly. Okay. So that's when we go back and say, okay, instead of, we're going to have 3.75 and our cap rate, what we say, 4.25. All right. So now we're getting an internal rate of return. Okay. So if our internal rate of return, remember, if we're promising our investors 8, then our overall internal rate of return needs to be around 10 or 11. So we got to have at least that in order to give them an 8 pref. So it depends on what we tell them we're going to give them. If we tell them we're going to give them a 14% internal rate of return, then we need an overall of 16 to 17, blah, 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 blah. So in this case, obviously, it don't make it. Although it still likes the financials. You got a good break-even occupancy, debt yield, everything else based on the financials that we inputted into it. So now I got to come down here, and if I want, what internal rate of return do you guys want to see? What's our discount rate here? Class A minus market, Class A market, Class A property. What's our discount rate here? What's our risk? What internal rate of return do we need to invest in this deal?
10%.
Okay, since you're the only one that answered, I will put in.
Because we're doing a pref of 8.
Whoa. Don't do that. Don't do that. I just broke the whole model. Okay. So we need to get this up to 10%. So the only way to do that is to manipulate the purchase price. So now let's go to 35 million and see what we get. Ooh, that's a big number. So let's go to 40 million. Now we're at 15%. So 43 million. And now we're at 10, basically 10%. So if you have a 10% discount rate, then you can only pay $43 million for this property. Okay. That's all you have to do is just manipulate this. We don't have NPV to tell us by how much. We can just sit here and start playing with the purchase price until we get what our no more than is based on that internal rate of return that we want. Now, we're not going to get the hurdle, but we will be able to get the pref and the accrue and the 70-30. We can see what we're making down here. So on refi exit, after exit, managers, so the sponsors who put no money into this deal, okay, 100% went to Class B shares. They put no money in the deal, and they're going to get back $2.75 million after sale. Now, that's not typical. Typical, the sponsors will put money in. You guys see how this model worked? Sorry about the breakage. We fixed it, but now you see what to look for when it breaks. So that was actually good. Questions? Comments, bitches, moans, complaints?
Typically, how much does a sponsor put in to a deal?
It's not typical.
Okay.
No questions? All right, well, that's the financial models. Mario, go ahead.
Yeah, it's too over my head to make questions, so I just need to go back.
This will be recorded.
Question.
Go ahead, man.
So in the model, you put vacancy is 9%, and we looked at last week at the market average vacancy is about 5%.
Right. So if we go back to actuals, you can see that we're at 9%.
Right. The about 3.4% additional to the market vacancy is from the 312. Even the loss, that's we are adding.
We're adding the credit loss, correct. Instead of putting the concessions and credit loss and bad debt all here, we're just including it here for time.
Okay. Now I know for smaller property, we don't have a luxury to have all that detail.
Well, are you syndicating a smaller property or are you just JVing?
Just JV.
Then you don't need this model. Use my model.
Okay. Okay. For your model with the vacancy, we use the market vacancy.
No.
Because we don't have the number. I mean, typically for smaller property, we're lucky to have a P&L, or they only send us, hey, what is the total rent?
You're going to use market vacancy if the market vacancy is greater than 5% plus your credit loss on smaller properties. And you'll be able to see the credit loss because it'll be in the P&L from the rent roll. You can take the rent roll and say, okay, now you'll have to get a history. If you just have a single line P&L, you'll need the last 12 months of rent rolls in order to do this. You can add up all the income from the rent rolls and balance it against the P&L, and the difference is your credit loss.
Got it.
Okay.
Thank you.
Yes, sir. Awesome. All righty. Well, let's conclude this bad boy. So, conclusion. It all boils down to one word. What do you guys think it is?
Data.
I like data. I can accept data. Not the
Profit.
one. No, not profit. There's one of three words I would accept. Data is one of them.
Assumptions.
Assumptions is the other one. And what's the last one?
Is it risk?
No. What's the name of the workshop?
Underwriting.
Underwriting what?
Fundamentals.
Fundamentals. It all boils down to the fundamentals. Fundamentals, assumptions, and what was the other one that I said I'd accept?
Data.
Data. Yes.
Yes.
Because it's the data that we can find the assumptions to be able to utilize the fundamentals. Okay. That's the conclusion. It literally is all about the fundamentals. So going back to session 1 and looking at all the acronyms and definitions, looking at the APOD, comparing that to a profit and loss or a T12 and seeing how all that works. And then going into a market and determining what the 6 assumptions are. What is your market rent or projected rent? What is your vacancy? What is your income growth, your expense growth, your loan assumptions, including refi, and then cap rate, both at refi if you're going to refi and at exit if you're going to exit. And then we have our tests, which for your projected rents are, what is, you guys tell me, do a little test here, a little quiz. What is the test for market rent? What can we look at to determine if market rent is in line with the market or not?
Co-star?
Income,
What kind of income?
average income.
Median household income. That's our test for market rents. Okay. Doesn't mean that there aren't people that can afford the higher rent, because median is the middle. Means that half the data is higher and half the data is lower. It's just the median, but it's a good conservative number to work to, okay, for market rent and whether that market can afford it or not. Okay, the other test is operating expense ratio. So how do we determine operating expense ratio? What do we divide? What two numbers do we divide to get it?
Income and expenses,
Which income?
gross,
Gross what? Gross rent or
rental
gross
income,
operating?
gross rental income,
Gross operating income.
gross operating. Thank you.
After other expenses, the bottom number, gross operating income. So expenses divided by gross operating income gets us our operating expense ratio. For older properties, what don't we ever want to see lower than?
50%,
45.
45.
45 to 55 is pretty typical for older properties. Back in 2018, when I surveyed over 100 T12s between Northwest Florida, Alabama, and Southern Mississippi, it averaged about 4.8% for 1970s products. Okay, those were very well operated, 200, 300 unit properties. Okay. And then what's the final test that we can do to see that our underwriting will make sense to the lender?
The yield to the lender.
Well, close. It's loan to value to debt service coverage ratio. So if I'm asking for 75% LTV so that the lender doesn't laugh at me and think I don't know what I'm doing, my debt service coverage ratio needs to be above their lender minimum. So if it's 1.25, then you should have a debt service coverage ratio higher than 1.25, that a loan to value of 75% would work.
Yeah.
Okay. So remember, it's minimum of loan to value or debt service coverage ratio. So that's just another test to see that your underwriting made sense, because you made loan to value. That means you're appropriately priced and your year one cash flows work. Okay.
Yeah, for the debt service ratio, the bank may entertain if it is less than 1.25, we have to put additional cash to it.
Most won't entertain it, man. You probably could negotiate that with the lender, because you're going to do this business plan. They may say maybe you need to go get some kind of bridge facility or something like that. We're talking about permanent lenders. They want to see between 1.2 and 1.4. That's pretty typical. I've only seen above 1.4 once, and I've only seen below 1.2 once. Other than that, it's typically between 1.2 and 1.4, based on the risk of the market, based on the risk of the deal, and based on the risk of you.
Got it.
Okay. All right. Homework. Yes, even on the last day, there's always homework. Okay. Find a tool you'll use. Doesn't have to be Synthesis, doesn't have to be mine, doesn't have to be SDA, any one of them. You can create your own. There are classes that you can take. CCIM does the building your own discounted cash flow model. You can go take a course and build your own, like I did. Practice underwriting deals. If you can't find any on the market, just email me. I've got dozens of T12 sitting on my frickin' desktop I can send you, because I've saved every single deal I've ever underwritten. So if you just want some, just let me know. I'll send them to you. You can practice. keep in mind they're older. So they're definitely not going to work at today's numbers. Or they'll look really freaking good at today's numbers based on the purchase prices from the OMs. And then live by the fundamentals. All boils down to the fundamentals.